Assalamualaikum and good evening, Doctor. My name is Fatin. So, when we think about Amazon and Walmart, we often see two giants competing in a different way, one physical and one digital. So, how do they exactly they create values to their shareholders? So, on the first part, we will discuss on the financial ratio analysis for decision making. For question 1, I will compare Amazon and Walmart return on equity using two-point framework and discuss the drivers of each company's profitability. To calculate the return on equity using the two-point model, we need to calculate the profit margin, asset turnover, and financial leverage. Amazon return on equity is around 37.44% compared to Walmart 15.98%. Amazon high return on equity is mainly driven by strong financial leverage and healthy profit margins thanks to their diversified business model and high profitability of AWS. On the other hand, Walmart return on equity is powered by higher asset turnover. Their physical stores are very efficient at generating sales, but their profit margin are thinner because they focus on keeping the price low. Walmart also has a moderate financial leverage without over-reliance on debt. For question 2, we discuss the differences between Amazon and Walmart's asset utilization using the asset turnover and capital intensity ratio, as well as the strategic insight from this comparison. Walmart asset turnover is about 2.29, which is much higher than Amazon 1.39. This shows how efficient Walmart at using its stores and inventory to drive revenue. Amazon lower turnover reflects its heavy investment in technological infrastructure and digital services, which takes longer to translate into sales. In terms of intensity, Walmart has a more asset heavy base model with significant investment in physical store. Amazon, by contrast, has a lighter model focused on more technology and digital platform which allow for lower capital intensity. In conclusion, Amazon leveraged technology and cloud services help to achieve higher margin and return despite lower asset efficiency. It focused on diversified operation and digital advantages. On the other hand, Walmart is specialized in operational efficiency with high volume sales to drive profitability, perfectly matching their cost leadership strategy and volume-based business.
Hi guys, my name is Wei Ching and I will be talking about the next question. So Walmart actually shows a stronger presence in physical retail while Amazon actually leads in the digital infrastructure as we know, right? So based on the financial ratio we have calculated, how does each company operating model actually impacts its profitability and efficiency, which I'm going to be talking about in the next two slides. All right, so let's start by comparing the profitability between Amazon and Walmart case itself. So as shown in this table, we can see that Amazon actually outperformed Walmart across all measures of profitability matrix itself. So mainly this is because of its diversified digital business model and they have a higher margin service like AWS and advertising services itself. So let's go through it. So Amazon profit margin is about 5.53% compared to Walmart, which is about 2.42%. This actually shows that Amazon actually earns more profit from each dollar of sales. Whereas looking at the return on assets and the return on investment capital, Amazon actually gain is leading because this is showing that they are actually using its assets and investment more efficiently to actually generate their profit. Whereas for their return on equity, actually Amazon delivers around 27.44%, significantly higher than Walmart, which is about 15.98, which tells us they have a stronger rewards for their shareholders, right? So then finally, right, gross profit margin has seen from this table shows there's a major gap as Amazon actually recorded around 39.55%, whereas Walmart, which is about 24.83, which is because of their strong control over cost and digital revenue stream. So in short, right, Amazon digital first strategy actually helps them give a higher profitability and better financial return, while Walmart focuses on high volume, cost driven retail operation with thinner margins itself. Hi, so now we're going to look into the efficiency between Amazon and Walmart itself. So we're going to start off at the asset turnover, which Walmart actually recorded a higher ratio of 2.29 compared to Amazon, which is about 1.41. What this actually tells us is that Walmart has a stronger ability to use its physical assets, such as its stores, inventory, and generate sales very quickly. Whereas for its inventory turnover, Amazon actually leads a slightly higher rating with a 10.54, whereas Walmart which is about 9.4. This actually highlights that Amazon strength in moving inventory faster thanks to its efficient fulfillment center and logistic network itself. Whereas for their receivable turnover, right? So Walmart shows a much higher ratio of 89.78 compared to Amazon, which is about 17.02. So this actually means that Walmart collects cash from its customers much faster, which is typical of a point of sale transaction in their physical store itself. Moving on onto the accounts payable turnover, Amazon has shown a lower ratio at about 3.9 compared to Walmart, which is about 8.74. This will actually suggest that Amazon takes a longer time to pay their suppliers, giving it more flexibility in managing their cash flow itself. So in summary, right, Walmart actually operates with stronger physical efficiency and faster cash cycle, while Amazon itself excel in their inventory movement and strategically manage its payables to optimize cash flow within its digital model. All right.
Good morning, Doctor. I'm Prasanna Kaliselvan here to explain about the Part B, which is liquidity and risk considerations. For the question number 4 is considering the current and acid test ratios, which company appears more liquidity and financially resilient in the short term, and what are the impact does this have for the managers? So let's see. Okay, first of all, let's see what is current ratio. Current ratio is a measurement that shows the company's ability to pay the short-term liabilities using their total current asset, such as cash, receivables, and inventories. The ratio close to or greater than 1 indicates that a company can cover short-term liabilities without financial strain. So when it's come to Amazon, the current ratio is approximately 0.93, while Walmart is around 0.89. So this indicates that both companies are slightly less current asset than the current liability, and in that comparison, Amazon's position is slightly stronger than Walmart. And for the quick ratio, however, it provides a stricter measurement in liquidity. It removes the inventory from the asset and focus only on the most of the liquid assets such as cash and receivable. In this case, Amazon's quick ratio is about 0.76, meaning it can cover 76% of its current liability with its most liquidity asset. Walmart's quick ratio is significantly lower, approximately 0.24, meaning it can cover only 24% of its current liability with its cash and receivables. So it seems like Amazon is more liquid and financially resilient in the short term. For Amazon's manager, this meaning a greater flexibility and lower risk in operation financially decision making. For Walmart's manager, it seems to be a bit stressed. It stressed the importance of maintaining strong sales and optimizing the inventory turnover and being cautious in the liquidity management to avoid financial strains. So question number 5 is evaluate the financial leverage and debts to equity ratios. Which company carries higher financial risk and how should this influence investment or operation decisions? Okay, from this case, data shows that Amazon's financial leverage ratio is approximately 3.44 compared to Walmart's 2.89. Amazon's debt to equity ratio stands out about 2.44, higher than Walmart's 1.88. These ratios clearly shows that Amazon uses more debt relative to its equity and assets comparatively with Walmart. A higher financial leverage ratio means a greater portion of company's asset is financed through liability rather than shareholders' equity. A higher debt to equity ratio indicates its heavier dependence on the borrowed money, which increase the company's fixed obligations such as interest of the payment and financial exposure. Thus, Amazon carries higher financial risk than Walmart, although the leverage can enhance return periods of stronger earning growth. It can also magnify the loss and cash flows problem during the economic downturns or the periods of operational unperformance. So the managers must actively manage the debt service, preserve the liquidity buffers, and make the conservative assumption in the financial planning to protect the company's resilience in violent market.
Hey guys, so now we're going to move on to the leadership and vision question itself. Hi guys, my name is Wei Ching and I will continue on to the question 6, which is about what leadership mindset or managerial approach would you recommend on portfolio managers reluctant to invest in tech-driven companies such as Amazon? All right. So to help portfolio managers who are actually reluctant to invest in tech-driven companies such as Amazon, there are actually two key recommendations which are crucial. So firstly, adopting a growth mindset and adaptability is essential. So managers must be open to continuous learning, especially about evolving businesses models and new technologies such as companies like Amazon actually has demonstrated how adapting through initiatives like AWS can actually drive strong financial performance and long-term success, and which actually help encourage innovation and resilience, which will help the firm stay competitive and relevant in the market. Secondly, applying a data-driven and evidence-based decision-making approach is also critical. So managers should actually base their investment choices on hard financial data such as return on equity, profit margin, and asset efficiency ratio rather than relying on outdated perceptions and personal biasness. For example, right, Amazon profitability growth and DuPont analysis, right, has shown strong fundamentals that should not be overlooked. Additionally, investing in regular industry training and building technological awareness among managers can further support inform managers to for their strategic investment decisions itself. All right.
Okay, hello Prof. Okay, this is Shawal. Okay, we go to the question number 7 is how can manager balance innovation and traditional financial performance indicator in making long-term investment decisions? Okay, balance innovation and traditional financial performance. Long-term investment is a crucial and important for managers to see how the business grows. As a manager, it must have a clear picture and make right decision to foresee betterment of company for the future. Balance and innovation, balance the innovation and traditional finance performance must come with approach and strategy from manager by doing the decision. Okay, we go to the Amazon or Walmart case study. So, case between Amazon and Walmart. Jenny finds both company are doing the same operating business, like selling a product on physical store and online platform. But performance of a New York Stock Exchange shows that performance of Amazon is better than Walmart. It's a 55% of a different stock exchange. This interpretation performance show the difference on the Walmart only running a business selling a product, but Amazon running a diversified segmentation that can be benefit back to the each other segmentation. Walmart was on innovation earlier than Amazon back on the from 1983 and 2000 by computerizing the system and allowing customers can buy online. Walmart generates the sale only from there. It shows the traditional financial performance. Different with Amazon, that segmentation of AWS was generated income of Amazon from supplement AWS to support their retail, their retail business. So we go to the manager decision making. As a manager, balance the innovation and traditional performance, financial performance like Amazon can be good reference to apply starting only selling a book, but now all consumer goods and generate the income from the support other business segmentation. As a manager, the best approach to start strategy for this by referring the financial ratio formula like a financial leverage ratio and debt to equity ratio. Manager can use the financial ratio by comparing the total asset over equity. By practicing on this company, on this, by practicing on this company which is good on long-term investment for innovation. That's how money can leverage the debt on the total asset. Company can continue to have a new asset and generate return over the equity company receives. Manager also can use the debt to equity ratio by traditional financial performance of the company. Company can use this formula to see whether the company is serving the debt if anything happens to company. So that's all from our group number 7.